The magic number for self-managed super funds is $200,000. Bigger self-managed superannuation funds perform better than smaller SMSFs because they hold a wider variety of investments and are more cost-effective to run, a new study has found. Research covering more than 20,000 SMSFs over a 6-year period has found that funds with investment balances below $200,000 delivered worse investment returns than their larger counterparts. The report, by the University of Adelaide's International Centre for Financial Services and SMSF services provider SuperConcepts, says the SMSF studied had average assets of $845,000 but held an average of just 2 different asset classes, such as real estate, Australian shares or cash. SMSFs have surged in popularity in recent years as many mom-and-dad investors pumped investment properties into them to grab huge tax benefits. Figures from the Australian Taxation Office show that the number of SMSFs has grown 31% to 577,000 in 5 years, and they now hold total assets of $622 billion. Larger funds tend to perform better year on year, are more diversified, have significantly lower expense ratios, and are generally older than smaller funds, the report says. University of Adelaide professor of finance Ralph Eves-Zerbriggs said SMSFs below $200,000 suffered a double whammy because the running costs were relatively higher on smaller balances and they could not diversify enough to produce higher returns. SuperConcepts General Manager of Technical Services and Education Peter Burgess said size matters. While cost is not the only reason people set up a self-managed super fund, if you have got less than $200,000 it's not going to be the cheapest option for you, and you don't get the benefits of investment diversification, he said. The $200,000 threshold is for the total self-managed super fund, allowing family members to combine their savings. It's very common to see self-managed superannuation funds with 2 members, being a husband and wife, Mr. Burgess said. The research found that SMSFs invested in an average 2.15 asset classes, up from 2.065 years earlier, but still well below retail and industry super funds that spread members' money across a wider range of assets including Australian and international shares, bonds, cash, property and infrastructure. The reason why funds above $200,000 perform better has a lot to do with the fact that they are diversified, Prof. Zerbriggs said. However, the rapid rise of exchange-traded funds, or ETFs, which could spread money across many countries, stocks, bonds or other assets, is changing the game. It's now possible to have under $200,000 and get the same type of benefit a retail fund manager will provide, Prof. Zerbriggs said. If you have an SMSF below $200,000, perhaps look at ETFs.